Hello there, and welcome back to part 2 of the Black Market panel discussion. So I think for those of you who have not catch part 1 of the discussion yet, it's already live on our YouTube channel right now. So definitely do check it out because the mentors have shared a lot of their market insights, their different trading styles, how they look at the macroeconomics of the US market, and more importantly, they actually answered 3 important questions on where they expect interest rate, inflation, and the upcoming recession. So joining us today is, of course, our 7-figure mentors, where they've each managed to build up a portfolio of 7 to 8 figures, and they've adopted very different strategies, but yet at the same time, they've all consistently beaten the market. So as we all know, the Black Market panel discussion is actually a lead up to our actual Black Market event 2023. So the theme of this year is actually exposing Wall Street's dirty secrets. So Adam, is there anything that the audience should know about exposing what all these big boys are doing right now?
Okay, so I'd like to share with you 3 myths that Wall Street has perpetuated for decades and the truth, the reality behind it, right? So the first myth is that Wall Street has convinced people that professional investors, professional fund managers are smarter than you. They've got more resources, they've got more data, they've got more computing power. So you might as well let them manage your money because they're smarter than you, right? But it's not the truth, right? So the reality is that the majority of professional fund managers actually underperform the market index. So specifically, in a 1-year time frame, more than 50% of professional fund managers underperform the index. Over a 10-year time frame, over 90% of professional fund managers underperform the index. So what does this mean? This means that if you just buy the index ETF, you will outperform 90% of professional fund managers. You get better results than them without paying them all the fees. The second myth is that you should make investment decisions based on listening to the Wall Street experts, the analysts, the economists, and the fund managers. In reality, if you actually listen to most of their advice, not only will you underperform the index, but you may actually lose a lot of money. So let me give you an example. After the financial crisis in 2008, 2009, the bull market started in early 2009. And from 2009 to 2022, the S&P 500 index went up 500%. If you just bought the index, you'd have gone up 500%. But if you had listened to all these experts, you would have missed out on the 500%. So if you look at this chart over here, you can see that throughout that entire period, the majority of these experts were telling you that the market was going to crash, that the market bull run was not sustainable. In fact, most of the experts only said that the bull run started in 2012, which means they were 3 years late. Now, I wrote a book called Profit from the Panic, some of you will remember, which I launched in January 2009. Where I shared about how I was buying great companies which were very undervalued. And that's how I made, well, my first fortune back in 2009, 2010. But again, most people listening to these experts would have missed out on those gains. More recently, in 2020, after the COVID crash, you guys remember I created a video that said the bull market is back in April 2020. And that's how I made over 40% return in 2020. But again, if you look at this chart over here, if you listen to the majority of Wall Street experts, most of them did not expect the market to go up. Most of them expected it to crash and they shorted the market and they missed out on the 40% gains. In fact, by the time Wall Street and the media told you you were safe to buy, the market was already up 70%. The third myth perpetuated by Wall Street is that, hey, if these professional investors can't beat the market, what chance do you have as a retail investor? But the reality is that a lot of retail investors, they don't realize that we have actually a lot of inbuilt advantages that if we learn to exploit, we can easily beat the professionals. So many retail investors, they're not aware of their inherent advantages and they don't know how to leverage on it. So let me give you an example. When you put your money with the professional fund manager, they charge you a lot of fees. Like a mutual fund can charge you up to 5% sales charge, which means before you start, you're already down 5%. But if you manage your own money, hey, you save 5%. So that's an advantage people don't understand. The second thing is that professional fund managers, there are some stocks they can't buy because of mandates. That they can't buy certain stocks in certain countries. in certain sectors, in certain industries. But we as our own investors, we can buy any stock as long as it's a great company. Also, professional investors are sometimes forced to buy stocks when they are overpriced. Because when people put their money into the fund, they have to deploy the funds. They have no choice. So they end up buying stocks when they're very high. But we as our own investors, we don't buy when the market is very high. We only buy when it's very low. And when the market crashes, that's when we buy. But oftentimes the professional fund manager, they are forced to sell stocks during the crash because their customers withdraw the funds. So we have a lot of advantages that we don't utilize. So in the upcoming black market event, I'm going to show you how, as a retail investor, to take advantage of your inherent advantages, and how do you not only beat the professionals, but how do you beat the market as well. And in the words of the great Peter Lynch, who was a legendary fund manager himself, the very few that actually could make money, he said this. He said that the dumb money, people think the retail investors are dumb money. He said, but the dumb money isn't so dumb. And the smart money, which are the professionals, aren't so smart. In fact, he said that the dumb money is only dumb when they listen to the smart money. So remember, you're only dumb when you listen to the professionals most of the time. But when you look at the individual companies, you understand how to invest yourself, that's when you really become smart.
Right, thanks Adam. I think that was really, really interesting insights and revelations for those viewers out there. Maybe for Bang, what is the biggest myth in the option space today?
Yes, in the option trading area, one myth that I've seen is Wall Street makes you believe that buying options is a way to make money, right? And lots of option traders, especially the new one, get lured into that idea that hey, you can use a small amount of money, capital, you could potentially get a big price or returns of it. In reality, buying an option is like you go to the casino and you keep putting coins into slot machines or the jackpot machine, right? Once in a while, you may get some small prizes, or if you're really lucky, you could get a bigger prize. But in most of the time, you would lose money. But you will tell yourself that, hey, this is just a small money. And then you keep putting more coins into the machine, and you end up with losing a lot of money. Now, when you are losing money, guess who make the money? Well, the one that owned the machine, right? Which is the operator or the casino himself. Then that is what Wall Street doesn't want to tell you, doesn't want you to know that the one who sell the option that is making money, not the one who buying it, right? So learn how to make money by yourself by selling options, being the Wall Street yourself, and don't keep buying call options the way that you've seen many years ago that people keep buying the meme stocks and pushing up the price, and then they lose most of money most of the time. So come to my webinar where I will show you how to sell options to make money.
What about you, Elson? I think you are one of the top performing traders in your firm, in your prop firm. So was there any insider secrets that you have seen over the last, during your stint there?
So when I joined the prop desk, right, I realized that a lot of the top performing traders and even my former bosses, right, when they trade the markets, right, they are not using the traditional indicators. In fact, they were looking out for consistent patterns on how the market is being manipulated or rigged. And when I joined desk, I realized that it's not as simple as what people think, right? The market is rigged against the normal retailers. Okay, so in order to beat the market, you need to use discipline, risk management, and even skills to position yourself. Gone are the days where you beat the market using latency, or we call it speed. Because right now, the market makers have their servers, right, in co-locations at the exchange, right? So when they have servers in the co-location, is, for example, like when you put in the order, right, let's say a buy order or bid into the market, and then you realize that why is it that someone always managed to get in front of you, for example, if you look closely enough in the market depth. It's because the market maker is there, and he controls more than 90% of the liquidity for the products, whether it's stocks, forex, futures, and even crypto. So you can't beat them in terms of speed because they have the fastest speed. and they are at the co-location. But what you beat them is in terms of your skills, right, your discipline. It's very hard to go against the psychology of the crowd if you do not understand market manipulation, because you were not there to maybe buy when there's bad news or sell when there's good news. But let me share with you one important lesson I learned throughout my years of trading is that if you were to buy when it's good news and you sell when there's bad news, you will always buy high and sell low. And the worst part is that what the market maker does is not illegal, it's actually legal, right? But they are not there to provide the market making service for free. They make money from the bid-ask spreads and also from what we call retail flow manipulation, right? Causing retailers to buy high and sell low, for example. And in my upcoming webinar, I'll be sharing with you guys some of the secrets of the market makers, the big boys, how do they manipulate the retailers, and so that you can arm yourself with this knowledge to avoid being trapped by this kind of unnatural price movements and profit from the market consistently.
Okay, thank you, Elson. So I think the three different mentors have really shared different perspectives on how the market is essentially exposing the different market manipulation tactics. And this is of course because they all have different experiences, and through their long years of trading and investing, that's how they find out of all these different quirks and nuances of the market itself. So I think before we move on to maybe the outlook and even your game plan for 2024, I think one important aspect of investing or even trading is really managing market psychology or managing your own personal psychology when the market is not really in your favor or it didn't pan out as expected. So maybe I just wanted to ask Adam, were there any surprises in 2023, and maybe how did you manage your own psychology throughout the year?
So far 2023 has actually turned out almost exactly the way I expected. It's been pretty textbook. As you guys know, if you've been following me, in March of this year, I said that we have started a new bull market. And the reason is because I look at the price action, I look at the moving averages. So historically, I know that once the 50 moving average cross above the 150 moving average and they start sloping up, 90% of the time, it is a bull market. And sure enough, it has been a bull market. So that turned out pretty much in line. And last year, the three worst performing sectors were technology, consumer discretionary, and communication services. And usually the three worst sectors in a bear market become the best three sectors in a new bull market, which I did mention early this year in my outlook. And that has turned out exactly the way I anticipated. So far this year, technology, consumer discretionary, and communications have been the three best performing sectors. So that actually turned out exactly as I expected as well. Also, I also expected that from August to September, October, we're going to have a weak period. Why? Because again, it's a seasonal weak period of the market. So in a way, it turned out also pretty textbook. Okay? So that turned out pretty well. But at the same time, I share how I manage my psychology. As an investor or as a trader, although I use a lot of statistics and I say, oh, it's a bull market, I expect a correction, but I never invest and trade based on predictions. I never invest and trade based on expectations. I always invest and trade based on, okay, is the company good? If it's undervalued, I just buy. If I'm trading, if there's a trade set up, I just take the trade, I put a stop loss, I put a profit target. So all these readings of the market, in a way, is just to get a general direction. But the actual decision is based on the actual setup of the company, right? And after being in the market for over 30 years, one of the things that I've learned is that anything can happen in the markets. Anything can happen, okay? So that's why in investing, we always diversify. In trading, we always have a stop loss, so that even if the most unexpected happens, you're still okay. So that's always been the psychology that keeps me safe. Now, what didn't I expect? So what I didn't expect was that interest rates would rise so fast. Now, historically, studying the markets, I know that usually when interest rates rise, all stocks do well. If you go back in history, actually. Even bonds and REITs do well historically. But this time, rates rose too fast. Unprecedented. So when the rates rise so fast, only certain companies did well, which are the certain big tech companies. But REITs have been whacked. Bonds have been whacked. small caps have been whacked, even consumer staples have been whacked. So that's something I didn't expect, and I'm taking advantage of it, which I'll talk more about later on. And of course, the 10-year yield, I didn't expect it to hit as high as where it is right now, although I do think that we are near the top and we should be coming down soon. But it's a good thing, because the reason the 10-year yield has been going up is because the US economy is stronger than expected. You know, most people expected a recession this year. Not only do we have no recession, but the US job growth and GDP growth is like, wow, stronger than anyone expected. So because of that, the 10-year yield going up is actually not a bad thing. It's actually a good thing, because stronger GDP growth will eventually translate to stronger profits and a stronger stock market.
Bang, what about yourself? Anything unexpected for 2023?
Well, one thing that surprised me in this year has been the very strong first half performance of stock market. Despite the Fed being very aggressive in hiking interest rates and lots of bad news in the geopolitical, the wars going on, the market just shook it off and moved on. Because I was expecting a more stagnant kind of market in the first half, and I was positioning myself in that in my portfolio. But when I listened and watched Adam's video on the YouTube video, when you call the bull market is back, that's where I increased my positions and exposure, and right through the market rally up. So that's where I changed my mind and just reallocate my positions and benefit from the market rally.
Right, one thing from Bang's explanation, you can see that he remains fluid in terms of his expectation. He doesn't just stick to one view, and like many of the doomsday prophets, they stick to that view and then they have continuously been wrong for when the market continues to rally on. So Alson, yourself in particular, anything unexpected in 2023?
Okay, for me, I'm surprised that as the interest rate goes up and the fear of inflation kicks in since October last year, right? It was actually the bottom for the entire stock market, and that was the best time to buy in, right? So as the news keep coming in about higher interest rate hike by the Fed, market continue to move higher. But actually, by itself, right, the market has shown a price action bottom there in October. There was actually a bear trap pattern, which is bullish for the market, even though the news was bearish. And the way I actually managed my trade during this the last 1 year is that I make sure that I manage my risk accordingly. Okay, I do not have any expectation of what's the trade outcome actually. I just do my best to enter on trade setups that I think that has a good edge and let the result take care of itself.
Thanks, Alson. So I think one of the most important factor for many traders alike is really on this point of managing psychology, especially when the market is extremely choppy, extremely volatile, and sometimes the trade goes their way, sometimes they don't. So do you happen to have a tip or two for traders alike on how they can manage this part of trading?
I think that one of the mistakes that traders make is that they link the psychology to the amount that they're risking. For example, last time when I was a new trader in the prop desk, I remember my earlier days, when I lose a trade of, let's say, a few $100, I will think of it like as if I lost a few Big Macs meals, right? And that affected me to take on the next trade. And one thing that now that I do is how I manage my psychology is that I think of myself as the general instead. And then my capital is like my soldiers. I deploy them to capture more soldiers back. Of course, some will perish, but if I know that if I follow my rules, I will have an edge, and in the long run, I will bring back more soldiers.
Right. Thanks, Alson, for the tip. I think it's extremely practical, and also many traders can execute and to look at how to manage their psychology in general.
I think if I can add, I think one thing that, again, all three of us have in common, interestingly, is that we never invest or trade based on reading any kind of news. We read the news for entertainment, but we invest and trade based on the price action, the setup, or the fundamentals of the company. And I think the other thing that we have trained ourselves to do over the years is to not get emotionally attached to the profit and loss in our account. So when we see the account go up 100,000, down 100,000, it doesn't affect us emotionally at all. And whether you take a profit or loss, it doesn't affect us emotionally at all. And that's the only way that you can stay objective and to beat the market.
Right, completely agree with Adam. I think one, personally, at least for myself, I think one very key part that surprised me really in 2023 was the recent breakout of a conflict or a war in the Middle Eastern region. So then a lot of investors or traders alike, they have been asking around, like in many community forums that I see online, or I think even in our own Discord community, oh Adam, the war broke out. Is it going to result in a World War III? What's going to happen? What should I do? So I think first, maybe I'll get Bang. If you have any opinions on this, what's your perspective on this conflict?
First of all, what is happening in Middle East is terrible, right? And my heart goes to the victim. I just want to, tell you that it's very painful to watch what's going on. On the market reaction standpoint, the way the market has reacted so far has been very limited, very muted. We see a big, market gap at the beginning, but then recover and then rally after that. So it looks like the market is shaking off the political and the thing is happening right now. And in my opinion, if the Russian and Ukraine war could not bring the market down, I doubt this one will, right? So in my opinion, the market will move on, and we will continue to see the market much higher from here.
Right, thanks Bang. What about you, Adam?
Yeah, so geopolitical conflicts, there's no way to predict how long it's going to last. The Afghanistan war lasted more than 10 years, if you recall. And it's impossible to predict how widespread it will be. So I would say that if something is not knowable and not predictable, ignore it in terms of your investment decisions. Of course, we read about it because it's a human conflict and it is terrible. But in terms of investing and trading, totally ignore it. Because there's no way you can predict it. If you can't predict something, why even bother to look at it, right? Now, if you look back at history, every single conflict from World War I and World War II and Afghanistan war, Iraq war, all the wars, sometimes the market would go down. In fact, most of the time it did go down in the short term, but eventually the market will always rebound higher. And during all those times of conflict was opportunities to buy companies at significant discounts. So don't forget that Warren Buffett, the world's greatest investor, bought his first share of stock during World War II, when it looked like they were going to lose the war at that point. At the worst time of the war, he bought his first share of stock. And I think that's a lesson for all of us.
Right, I think I personally actually didn't even know that Buffett bought it when it was during World War II. So I think this topic is complicated, and there are a few shining spots at least in the markets today. And of course, I believe many viewers are interested into understanding whether there are several potential opportunities in the market right now. Of course, the most complicated one, which we'll want to dissect right off the bat, is about this topic around China. So many viewers have also sent in their questions saying that, oh Adam, I know that you hold companies like Tencent, like Alibaba. Has your views changed? Is China still investable? Should I continue adding into my position, etc.? Your view on China now?
Okay, so I hold not that many companies. I hold Alibaba, Tencent, Ping An Insurance, Hong Kong Exchange. These are the main positions, and a bit of Bank of China. Now, when I look at the individual companies, I have actually zero worries, and I'm not concerned because when I look at their results, they're actually doing pretty well. In fact, Hong Kong Exchange, which I also own, just reported results days ago, and revenue and profits were up double digit. Right? Alibaba, Tencent, Ping An Insurance, revenue up double digit, free cash flow up double digit. So the underlying companies are doing very well, even though the Chinese economy has not done well. So they are very, very good companies. Now, they may say, if the companies are doing so well, why does the stock price keep going down? People don't understand that, right? So what you have to understand is that, remember that in the short term, the market price is driven by an auction system, people buying and selling. And in the short term, the market price doesn't always reflect the actual value of the business. It's not always logical. In the short term, the market price is emotional. It's driven by news, emotions, sentiment, and manipulation, right? So right now, the reason the price doesn't go up is because of all this negative political and economic fear that the property crisis in China is still not resolved. The Chinese economy is not growing faster than expected. That's why the price cannot go up. Now the question is, will the sentiment change? The answer is it will always change. The only question is when. No one knows when. It'll take time to change. Of course, it's taking longer than I expected. I thought it'd be faster, but no. Okay. Now, always remember that when you are investing in something, you need to always take at least a 3 to 5 year view for your investment thesis to play out, right? And everyone say, oh yeah, I can take long-term view, but people grow very impatient. Now, if you look at China, since the bear market started, it's only been about 3 years. Yeah, it seems like eternity, but if you think about it, it's only been 3 years. Not even 5 years yet. So it's not as long as psychologically we think it is. So I'm still patiently waiting. Now, having said that, I'm not increasing my position. I've not sold any Chinese shares. I've held my Chinese positions. And I used to have about 10% allocation in my portfolio. But organically, because the price went down and my US stocks went up, so now organically, my Chinese stocks account for about 6% of my position. I'm not adding to it, okay, at this point of time. Because right now I think that US stocks, some of them are cheap as well. In fact, I see a lot of great US companies that are very cheap, so I'd rather add to the US ones. Right. Okay, because between the two, the US companies are more globally diversified, whereas China is more concentrated in China, right? Now, having said that, once I see that the Chinese market confirm a new uptrend, like the 50 moving average cross above the 150 moving average, or the price go back above the 200-day moving average, yes, then I may start to add more to China, when I see the trend confirmation. So, yeah, that's my take on China.
Right. Alson, I think in one of the previous discussions, you also talk about looking for opportunities and identifying small pockets of potential Chinese trade setups. So maybe you can share what are you currently doing, or what's your perspective on investing in China today?
I'm still positive on the China-Hong Kong market in the long term. It's just in the short term, when I look at the price action, I see that there could still be further downside, but I see it as an opportunity. Just like October 2022 last year, right, when we see many stocks bottom out and rally massively and make multi-bagger gains. So right now, I'm actively monitoring the Hong Kong-China market for setups and building my position whenever I see potential price action manipulation setups in the stock. It reminds me of during the time when I was in the prop desk, I was also trading the Nikkei index futures. And during that time, a lot of people actually say that the Nikkei, the Japanese market, is an aging population. There's uninvestable, there's deflation. It's one of the worst performing indexes during that time, 10 years ago. But when you look back, actually, after the Prime Minister Abe came to power, he initiated this thing called Abenomics. And since then, the entire stock market actually rallied very strongly. In fact, one of the best performing indexes in the last, I think, 10 years. So I see that Hong Kong market will eventually move out of this because it's still one of the strongest economy in the world, just that it's now closed due to political reasons. And so once it opens up or ease capital flows, right, or the Chinese government decide to push up their stock price or their indexes, I think there's still a lot of potential in this market.
Right. Thanks, Alson, for sharing. What about Bang yourself, investing into the Chinese market?
Well, personally, I have stopped investing or trading Chinese stocks since 2 years ago because, I'm the option guy, right? I use options for investing, trading, and for me, it doesn't make sense to trade options in Hong Kong market for 2 reasons. Number one, liquidity is very low. So if I sell an option, I need to reduce my price so low so that I could find a buyer. So that means I could collect very little premium for it. So that's the liquidity issue. Number two, the commission that the broker charged me for a transaction in Hong Kong is like 10 times of the US South. So the cost of transaction is just so high, it doesn't make sense to trade options in Hong Kong. You can argue that why don't I trade the Chinese stock that are listed in the US? Well, there are only a few of them, and some stock like Tencent, Piranha Insurance, they do not even have options in the US. So then I decided to stop, trading Hong Kong or Chinese market.
Right. I think likewise, you don't need to fall in love with a particular trade setup or particular stock. You also don't really need to fall in love with a particular geographic region as well. So I do believe that the world is your oyster. You can dabble in different markets, and especially when you see an opportunity that you understand, you can take advantage of it. But maybe just a small summary or personal take on what China is currently undergoing today. Let's not forget that it's the second largest economy. It's a huge country. They have so many provinces, so many people. It's very hard for them to transition out quickly and swiftly. So I think Bang did share over lunch with me the other time, where if it's a huge ship that you're steering, you need to steer it slowly and carefully. But I think over the last 2 or 3 years, the Chinese government has stepped in with very, very quick and swift policy actions, and now they are trying to handle and trying to move out and transition the economy slowly. So it might take time, and I think like Adam suggested, patience is a very important virtue, especially in investing and trading. But I think for those that are not interested, I think it's not really something that you definitely must have a stake in. And more importantly, if you are invested in a diversified company, actually, I think most of them actually do have China footprint. A lot of the UIP stocks in Adam's watch list as well, or even in the portfolio of companies he owns, they have China exposure. So for those of you who are interested, you can join Adam's Ultimate Investors Playbook as well. So I think that's the first part where we talk about China. So China is one of the bright spots. I would say dimmer spots because it has fell down from grace. But I think the second part, it's really this idea of crypto. So I think for crypto, we experienced a crypto winter for I think the last 2 years or so. And recently we see some huge bounce up in terms of Bitcoin and some of the other crypto projects as well. Specifically because there was this rumor that Bitcoin might potentially have an ETF that has recently just cleared for kind of a listing name in the DTCC. So on top of that, I think there's another event that a lot of traders are interested in next year, which is the Bitcoin halving event. So Elson, is there anything in particular that you are currently doing to position your crypto portfolio to take advantage of this trend?
So in recent months, I've been building up my position in crypto, especially Bitcoin, Ethereum, XRP, which is the crypto majors. Because I saw certain price action manipulation accumulation pattern, especially for Ethereum, okay? And I think my community knows about it, okay? Because I also share with them that I also invest in crypto as well. And I think that the upcoming narrative, for example, I mentioned about a Bitcoin halving and potential Bitcoin ETF, right? They will eventually come next year. And this has actually led to a lot of people FOMOing, fear of missing out into the price action. But I do think that once you have the ETF approval, when things get euphoria, it's actually time to sell, right? Buy the rumor, sell the news. And that's when I think after the sell-off, we form a base, then that's when I'll be even more aggressive to buy into crypto.
Right. I think on top of that, do you have a long-term perspective on crypto? So instead of rather than trading or buying the rumor and selling the news, are you positioning parts of your portfolio for a long-term accumulation?
So I do maintain about a sizable portfolio in the crypto majors. For now, about 70% of my portfolio in crypto, within crypto, is positioned in, as I mentioned, Bitcoin, Ethereum, XRP. Because right now the Bitcoin dominance means the market cap of Bitcoin against the rest of the crypto economy is about, I think, close to about 60%. And I think it will continue to rise higher. But once the Bitcoin dominance peak, I will shift out to other alternate tokens, because that's when I think the massive gains will come in. The 10, 20, 30x will come in once Bitcoin stabilizes and the dominance starts to reverse.
Right. So I think on this topic of Bitcoin spot ETF, right? I just wanted to ask Bang, if let's say the ETF is really approved, would you be interested or would you be thinking about trading options on the Bitcoin spot ETF? That's the first one. And second one, do you have a position or do you manage your portfolio to have any crypto exposure?
Perhaps I will answer the second part first, right? For me, it comes down to the philosophy of investment that I adopt for myself. I do not believe in cryptocurrency in terms of the fundamentals because I believe this is a known productive asset. It doesn't produce any cash or profit. So it's like when I invest in property. I prefer to invest in apartment or condominium where I can rent it out to collect the regular incomes, and I do not invest in land because I cannot get anything out of the land, right? So I don't touch the one that do not produce cash for me or dividend or yield, anything. I would rather put my money in the US T-bill where I earn 5%. I understand that for those who invest in cryptocurrency, they're not looking at 5%. They're looking at like 10 baggers. I understand that. But it could go to zero as well. So at my age and at my current stage of my life, I cannot afford taking that risk. So I don't want to take the risk that I can lose 100% of my investment. So that is my choice. Now, having said that, if there is the ETF on cryptocurrency, definitely as an option trader, I will explore it. And if the liquidity and the option premiums are good, definitely I could trade it on a short-term basis.
Okay. I think also do feel free to leave in the comment section down below if there is a Bitcoin spot ETF, would you guys even be interested in trading the options as well? So I think talking about China first, and then we pivoted over to crypto. Now I think the third area of opportunities is like what Adam suggested in the earlier part of the panel discussion, where because of the interest rate hikes, right, there are two specific sectors that got beaten down very, very badly. Firstly, it's REITs because it's essentially a real estate investment trust. So they are mostly very leveraged instruments. They take up debt and then they rent out their office buildings or wherever. And the second part, or the second sector that we look into is small cap stocks. And mostly, as you guys know, many of these small cap or micro cap stocks, they are just at the start of their growth curve. Many of them don't have huge cash piles, and they require a lot of debt financing, a lot of other financing options. And because of this huge, unprecedented increase in interest rates, it definitely hit them in terms of their financing costs and also their balance sheet. So Adam, do you have any specific thoughts about these two industries? Because some people might see it as a crisis, some people might see it as an opportunity. Yeah. What do you think?
So I don't invest in small caps, but I invest in REITs. So I've got a dividend portfolio where the objective is just to collect dividends with a bit of growth. So for my dividend portfolio, it consists mainly of the 3 Singapore banks and the selected high quality REITs that are all listed in Singapore. So here's the interesting thing. Now, if you go back historically, in history, right, whenever interest rates increase in the past, actually REITs also increase historically, okay? Because when interest rates increase, it's actually a sign of a growing economy. So when the economy grows, property prices go up, property rents go up, okay? But this time is different because this time the interest rate went up very, very fast, very rapidly, such that the REITs, their financing costs went up, the property valuation went down, and they were not able to raise the rents fast enough to offset the rise in the financing costs as well as the property devaluation. That's why REITs have dropped quite a bit this year, right? So yeah, in my dividend portfolio, the share price of the REITs have gone down in my portfolio. But the good thing is that my banks went up, so that offset. At the same time, I'm collecting very good dividend on the REIT, so that offsets it a bit, right? Now, so am I concerned about that? Well, not really. So to me, if I look at the REITs right now, I think that they are very, very attractive. If you look at the dividend yield on the REITs, right now they are about 1 to 2 standard deviations above the historical average. That means the dividend yields are pretty attractive, now at close to 6, 7, even 8% dividend yields, okay? And another way to value the REITs is the price to book ratio or the price to NAV ratio. And now it's like, again, it's like 1 to 2 standard deviation below the 10-year mean. So in other words, REITs are very cheap right now, okay? Now, if you believe that interest rates will eventually come down, which I think they will, probably next year, the year after, then REITs will have a very strong rebound. REITs will rebound very, very strongly, okay? So I think that now, for me, it's a great time to buy the high quality REITs and lock in the 6 to 8% yield. right? Because once they rebound, you won't get this kind of yields anymore, okay? Now, but having said that, I will only focus on very high quality REITs. Yes, there are some REITs that have got 10, 20, 30% dividend yields that look very attractive, but I wouldn't touch it because it's the future earnings and the dividends are very uncertain. So what do I mean by high quality? So if I can just share a few things I'll look at. Number one, a high quality REIT is one where they're able to grow their gross revenue consistently. Of course, you can ignore the COVID period, right? But generally, gross revenue, net property income must be growing, number one. Number two, their dividend per share must be growing consistently as well. Of course, again, you can ignore that COVID period, which was one-off. And of course, maybe the last 1 or 2 quarters where finance costs went up and pulled down the DPU. But besides that, DPU should be also increasing. The other thing is to make sure the NAV per share, the net asset value per share, should be also increasing over time. And most important, the gearing ratio. So only buy REITs with low gearing ratios. If you're very conservative, make sure it's 40% and below. Right. If not, at the most, 42%. But don't go above 42% gearing ratio. So those are for the REITs. Like I said, for small caps, I tend to not invest in small caps because small companies, they don't have very strong economic moats that defend them from competition. And I tend to only want to invest in companies that are monopolies. That's why I don't really invest in small caps. And also, their balance sheets may have more debt, which I'm not comfortable with. But I think small caps eventually will rebound very strongly once rates come down. So probably what I'll do is that I will gain exposure using the small cap ETF. There are many of them. One of them I'm looking at is the VBK, which is the small cap growth ETF.
Right. So maybe I'll raise my hand, representing the audience. I think you have shared a lot of good characteristics in terms of how you pick high quality REITs.
Yeah.
So of course it's not financial advice, by the way, but is there any specific names or in the REIT space, specifically in Singapore, that you are closely monitoring or looking at right now?
Well, I think in my opinion, I think one of the safer REITs would be CapitaLand Integrated Commercial Trust.
Okay.
That's, to me, one of the safest ones. CapitaLand Ascenders REIT.
Okay.
Fraser Centrepoint REIT. So these are a few which, to me, are the more stable ones,
right.
Stronger. Yeah.
Right. I'd just like to emphasize, not financial advice, it's just Adam himself, he's looking at these REITs counter. So I think moving on, I think for Bang specifically, are you looking at REITs or even trading options around some of these small cap stocks?
Yeah, first of all, REITs have no options, so forget about option. But REITs, I do own a portfolio of REITs. It's not small portfolio, it's decent, and I be transparent here, it's not doing well this year, right? But I don't care because I don't touch this money in the next 5-10 years. So imagine that I used to receive the paycheck every month. By month end I receive the paycheck, now I no longer have that. So REITs paying the DP or dividends, and for me that is my paycheck every month. And I maintain at the level that that's the dividend I receive from REITs are enough for my daily life, expenses and everything. And I choose not to pump more money into REITs. I understand what Adam said. REITs are dirt cheap right now. Many of them are selling at below book value, historical low valuation, and very high yield, 6, 7, 8%. But if I have extra money, right now, I would rather put into fixed deposit or T-bills, which earn about 5.4%. Less than the dividend, the DPU from REITs, but it comes with risk-free, right? So for me, that's what I'm doing now, at least until the half of next 2024, when I expect the Fed to start cutting rates. The moment I see the Fed cut rate, then I will perhaps allocate more money into REITs. I could be late by then, but that's okay to me. I'd rather be late than picking the wrong allocations, because I believe if rate continue to go higher, then the T-bill will go higher, and the risk will continue to underperform. And then once the rates are cut, then you see the reverse happen, right? And that could be a good time for you to lock in the 6, 7, 8% dividend yields for the rest of the life, right? So that's the beauty of REITs. not the time, that time has not come to me yet. So I kind of targeting about middle of next year, 2024. That's where I will allocate more to REIT, not now.
Right. I think in terms of locking in the yield as well, I think for some of the high quality names that Adam talked about, like some of these REIT names, their DPU actually climbs over the years. So on a cost basis, sometimes it might even go to 10, 11% if you hold long enough. Yeah. So that's the beauty of buying into some of this very great, good assets, good yielding kind of REIT positions. But I think, Bang, on small cap stocks, are you particularly interested in them?
Similar to Adam, I have very small positions in small cap or middle cap stocks, but they have to be profitable companies as well. So I cut down on the speculative stocks, the one that are not making money and not generating cash. So I already reduced my position for that, because in this high interest rate environment, those companies will continue to underperform. I only focus on the ones that are profitable and generating lots of cash, even that small caps company.
Right. Thanks, Bang. I think then for Alson, I think for REITs or small caps, have you been monitoring their price action? Is there any opportunity there right now?
So for me personally, I don't invest in REITs, but I believe in property, right? In general, I also invest personally in physical properties in Singapore, like commercial shop houses. Actually invested through my winnings from my trading over the years. Okay, and for small cap stocks, I do look at them, but I actually have a filter, a screener for myself. I look for stocks, even small cap stocks, where their average volume is at least $100,000. And for many small caps, their bid-ask spread, right, some of them can be very wide, more than 0.5% or even more than 1%. And these are small caps that I don't really like because they are very much illiquid. And if the stock is illiquid, right, it means that actually there's not a lot of people so-called transacting or playing with the market maker. And if you are the only one playing with the market maker, you're at risk of you're like the only fish in the pond. Then you'll be targeted. So I like to trade even penny stocks where there's good liquidity. The bid-ask spread is preferably less than even 0.5%. Okay, but even if it's less than 1% of the stock price, is fine as well. And I look out for price action signs like major flush down, false bottom, bear trap pattern to time my entry, because this is when I can execute a minimal risk entry for maximum gain for such stocks.
Right. Thanks, Alson. I think also after discussing some of these key pointers or key sectors that we have talked about, I think here comes the juiciest part of the entire discussion and the entire panel discussion. So I wanted to maybe go around the table and ask the different mentors on what are the different hidden opportunities that maybe other people are not paying attention. Are there any things that they can exploit on or they can look further into or investigate to take advantage of the next leg of the bull run? Adam?
Sometimes the best advantages are staring at you right in the face. Like a lot of people I talk to, they say, Microsoft and Google and Amazon, everyone knows about them. They're so big, how much bigger can they be? How much can I make from that? And I think you're making a mistake, in my opinion, right? So the biggest positions in my portfolio are a lot of these big tech companies. In fact, the Magnificent Seven, excluding Tesla, I own all of them, right? Meta, Microsoft, Apple, and so on and so forth. And although they are already up double digit this year, I think they are still undervalued in my opinion. And they are in a long-term secular growth phase because they are the leaders in artificial intelligence and automation, especially Microsoft and Meta and Google and things like that. And this is something where the US leads, if you think about it. No other country in the world leads in AI the way the US is. And I think if you ask me, in the years to come, many countries out there would have to purchase the AI technology from the US to make their companies more productive. So to me, I think the biggest opportunities would be, again, in those companies, Microsoft, Amazon, Google, and Meta. Someone asked me a very interesting question recently that if I were to start all over again today with a small portfolio, where would I invest? I think I would start with these first, seriously speaking, all right? But besides this, I think there's a lot of opportunities in healthcare as well. Now, generally, I love the healthcare sector because healthcare is a long-term growth industry. Why? Everyone in the world is growing older, living longer, right? Especially in the US. So there's big demand for healthcare services. And healthcare is also a defensive sector. Meaning to say, in a recession, you still need healthcare. In a recession, you still need to go for operations. So it's defensive plus it's a growth industry. And this year, healthcare has dropped significantly for two reasons. Number one, the healthcare sector is what we call out of rotation. Remember that money goes in and out of sectors. It's like musical chairs, right? So every time money flows out of a sector, everything gets cheap. Money flows in the sector, everything goes up. So I love to buy when money comes out of a sector. That's when it gets cheap, right? So this year, money has flown out of healthcare. Now, within the healthcare sector, there are many sub-sectors. Example, pharmaceutical. Now, personally, I don't like pharmaceutical because I think it's very unpredictable. Whether they got this drug or they didn't get a drug, they get approved, don't get approved, you can never predict. And even if the drug gets approved, the patent expires in 10 years, and if they can't replace, they are gone, right? So I don't like pharmaceuticals because you can never tell which one's going to win, right? Right now, Eli Lilly is winning, but you never know who's going to be next, right? Now, Pfizer is dying, you know? But what I like is medical equipment, medical devices, because that is more predictable. All hospitals need medical equipment. All biotech companies, they need medical equipment to do experiments and to create new drugs. So I love that space. And recently, a lot of the medical device companies have dropped a lot. And they look pretty cheap to me, so I'm actually looking at a lot of them. Companies like Abbott Laboratories or Thermo Fisher, Intuitive Surgical, Stryker and stuff like that. And they also dropped for a lot of short-term reasons, like the hospital strike in the US. Because of the hospital strike, there's all of the medical stocks drop, which is so short-term. And that's why sometimes the market can be very short-term emotional, which is very good because as investors, we make money because of the market's short-term stupidity. But you must make sure that you're not the stupid one that follows the market into the stupidity, right? The other opportunity are actually consumer staple stocks, like McDonald's, Pepsi, Procter & Gamble, Coca-Cola. These are usually known as a very safe companies, right? And actually, historically, a lot of the consumer staple stocks are normally very expensive. Normally, they are overvalued. But right now, they're actually starting to get undervalued. Remember, I told you earlier this year, I sold McDonald's, I sold Yum Brands because they're overvalued. Now, they're starting to get undervalued because of, again, some stupid reason, which is in the US now, there's a drug, Ozempic, that apparently when you take the drug, it helps you to control your diet. So people think, oh, people will eat less, they drink less, so all the food stocks drop, which again, I think is very, very short-term, emotionally stupid, right? Well, good, then it allows me to buy these food stocks at discounts. So that's another opportunity over there that I see. Right. Now, of course, a lot more, right? I'll share a lot more in the black market live webinar, but just a few right now.
I think I just want to have a side question. It's a personal question of my own. So Adam said that you own 6 of the Magnificent 7, Tesla excluded.
Yeah.
So I think for many viewers on the YouTube space, a lot of people are actually Tesla fanatics or they're very loyal Tesla stockholders. So in this case, would there be any price where you'll buy Tesla when it comes when it?
So remember that I'm both a trader and an investor. So in trading, I trade Tesla quite often. Right, and trading is based on the trade setup. So if I see a long trade setup, like Tesla is making a dip on the uptrend, or oversold, I will long Tesla, but usually using options, right? And if Tesla is like hitting resistance, I will short Tesla. So I've made a lot of money trading Tesla. So I'm very happy to trade Tesla, not about the price, but the trade setup. In fact, now Tesla could be having a reversal up. So I may actually go long Tesla very soon, but as a short-term trade. But as an investment, I don't feel comfortable because the difference is trading, I've got a stop loss. But investing, I don't have a stop loss. Investing is like, I buy for the next 10 years and I'm willing to close my eyes and not look at it. So for Tesla, I'm not like as confident for a few reasons. Number one is because one of my rules is I like to invest in companies that have pricing power. That means they're able to raise their price every year and they don't have to cut price to maintain market share. So the fact that Tesla has to keep cutting price to maintain or grow market share, that makes me a bit nervous. And the second thing is I tend to avoid companies with high physical capex that need a lot of plant, manufacturing equipment. I don't like companies with a lot of capex. And also electric vehicles or even vehicles for the matter, it's very competitive. There's so many competitors out there. So I like to invest in companies that have little or no competition, that have got pricing power, that have got no physical capex, and so it doesn't meet those criteria. Now, not to say Tesla can't go up. Of course it can go up, right? But I rather invest in something that I feel more comfortable with.
Right. So I think that basically answers the questions for many viewers that always comment in our comment section about, Adam, when are you buying Tesla? So I think moving on to Bang personally, where do you see particularly the pocket of opportunities in the markets today?
It feels like Adam has covered the entire thing for me, because the first part of his answer is very similar to what I believe in. I continue to see opportunities in those big mega cap stocks in the US that are making a lot of money. I mean, they're generating a lot of cash. So among the Magnificent Seven, I also own 5 of them. I don't even have Apple like you have. But perhaps when the price comes down a little bit, I will consider it. But those are the ones that are producing cash and profits that I will continue to have big position for the long-term basis. For the short-term basis, of course, I will continue to trade in a very nimble manner, in and now, have some quick trade and get out early. So that kind of how I see the market opportunities are.
Right. What about Alson? Do you have a particular bias to any sectors, or how do you manage your trade setups?
Currently now I'm focusing on beaten down previously hype up or growth stocks like Palantir, Tesla, and even like crypto related stocks like Coinbase. Because I see that because of the crypto narrative, upcoming crypto narrative in Bitcoin, it could actually push up all these stocks as well. And also China stocks. As I mentioned, China market, I believe eventually will recover. And I'm actively monitoring it now. And once it forms a certain price action manipulation pattern, I will go more aggressive into the underlying stocks.
Right. Okay, so I think it pretty much sums up a lot of where the current mentors are looking at in terms of where they want to take advantage of, where they are holding back a little on. So I think moving on probably to the last part of the entire discussion, many people are probably expecting or they're interested to know what are your respective game plans moving into 2024. So Alson, what's your particular game plan in 2024?
I think my game plan in 2024 is look out for more potentially multi-bagger stocks. Right? Actually, that's my favorite. I like to go in and have within my trading portfolio certain stocks that I can see at least a double in a short term. And my short term is around less than 1 to 2 years, right? Because this will help to turbocharge my trading performance. While my game plan is also to do technical swing trades setups every now and then to form a baseline performance in my portfolio as well. And as I mentioned, these are some of the stocks that I'll be looking at will be China stocks, Hong Kong stocks, and crypto-related stocks will be under my radar. So look out for my upcoming price action manipulation webinar where I'll be sharing with you guys more about bull traps and bear traps, how the market maker manipulate such stocks. Because these are the key patterns that I look out for before I enter and exit a trade setup. And I'll see you guys there at my webinar.
Okay, thanks Alson. Bang, what about you? Your game plan for 2024?
First of all, I continue to bullish on the market going forward, and with the prospect that the Fed could potentially cut rates, I think it would be good for the market as well. For me personally, I will continue to adopt a more balanced approach with some fixed deposit, T-bills, and the other one, I use the options to boost my income and return on investment. So that I believe that balanced portfolio would help me weather all kinds of market volatility and market conditions. In my upcoming webinar, I will introduce new strategy where I will show you how to collect premium or cash in advance. And while the cash that you collect there, sitting in your account, you earn extra income from the interest rate as well. So that's double returns, right? One from the option trade itself, and one's for the cash that you collect from the trade. And actually, personally, I hope the interest rate will continue to stay high for a long period of time for that reason.
Right. Thanks, Bang. And what about you, Adam? Game plan for 2024?
All right, so we always must remember that no one can predict the stock market in the short term. You know, anything can happen. All we can do is we can just look at probabilities. So if I look at probabilities, remember that historically, the stock market goes up over 73% of any random year, right? So if you take any random year, 73% of the time it's going to go up, right? But next year happens to be the election year in the US. And the election year in the US is the second most bullish year of the 4 presidential election year cycles, right? So the strongest year is actually the pre-election year, which is this year. Next year is the second strongest year. Next year will also happen to be the second year of the bull market that started this year. So historically, if you look at the last 22 bull market cycles, about 86% of the second year of a bull market is bullish. So the probability is that next year will be bullish. Again, no guarantees, but probability. But the most important thing is, for me, my decision on investing and trading has got nothing to do with the prediction. All right. So for me, for investing, it's very simple. If I find a very high quality company, the top 1% of companies that is undervalued, I will keep adding shares, or I keep holding and let it grow. So the whole idea is to own companies that will do well in any market condition, and to own a portfolio that will do well in any market condition, right? That's why my portfolio is diversified. So it does well, right? No matter what happens in the market. And will I sell stocks? Again, it depends. If certain stocks in my portfolio start to have super overvalued levels and they start to go up 90 degrees, I may sell to take profit. So it all depends on the individual companies, regardless of what the overall market does. When it comes to trading, again, most of the time when I trade stocks and options, like similar to Pham Van Alson, it's all based on the trade setup. So sometimes the whole market could be going up, but a certain stock could have a reversal down. I may short the stock and make money for it going down. Or the whole market can be going down, but there's one stock going up, I'll go long on that stock. So it all depends on that individual company, not the whole market.
Right. Thanks again. I think for the 3 mentors, you guys have probably benefited immensely from the various discussion points and the different insights. So maybe just to do a very quick summary on the different mentors' trading and investment style. I think for Adam, a large part of his portfolio is in long-term investments, where he invests in the top 1% highest quality stocks in the markets today. And of course, he supercharged his returns by using options and looking for trade setups. Bang, on the other hand, he's our options master here, where he actually employ a different option strategy to gain exposure, and he also trade sometimes in very short time periods, but other times he also do very long trade setups to take advantage and to gain exposure in the different positions. And last but not least, I think for Alson, he also he essentially created the entire price action manipulation strategy to really understand how market makers make the market and be able to benefit from the big boys themselves. So I think through the whole entire panel discussion, we have gone through a lot. We have talked about macroeconomic updates. We have even looked into different hidden opportunities that the mentors are looking at. And more importantly, some unloved sectors that they actually floated. So of course, none of this is financial advice, but please do your own due diligence, and these are just some of the mentors' opinions for now. So for the viewers out there, you guys are in it for a treat, because in our upcoming live webinar, we have a series of webinars that the different mentors will be sharing their exact strategy and how they profit hack the market. So the sign-up link will be in the description box down below. And the tickets are completely free. So hope you guys enjoyed the discussion. Hope you guys took away a lot from this. And this is CK from Piranha Profit signing off. And as always, keep winning. you.